It's official. Marc Chaikin just went live with the biggest prediction of his career. A new wave of volatility is coming for the stock market, and investors need to act immediately. Marc's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, with a 100% success rate for predicting where stocks will go next. During Marc's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Marc invented one of Wall Street's most popular indicators for picking stocks, still used by hedge funds, banks, and brokerage sites, and today found in every Bloomberg terminal on the planet. Now, Marc's inviting you to watch his brand new event as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming weeks. He's even sharing one of his favorite ideas free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now by turning the coming market volatility to your advantage. But Marc says you must act today before volatility hits the market. To watch his newest prediction in full, go to chaikinevent.com. That's chaikinevent.com. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show here on Stansberry Research. And joining me back today is a guest who says we need to prepare for the next wave of volatility to hit U.S. stocks. Please welcome back Marc Chaikin, founder of Chaikin Analytics. Marc, always good to see you. Happy to have you back with us.
Danny, good to be with you.
Yeah, I'm excited to get your point of view on everything happening on the economic landscape. And I know you have a very special event coming up with Stansberry, so also want to talk about that. But first, let's talk the Fed. Big Fed day here, Marc. You know, we know the hawkish stance. How hawkish will they be?
That's anyone's guess. It's going to be a hike, that's for sure, either 25 or 50 basis points based on what happened a couple of weeks ago in Powell's testimony before Congress. The market's been betting on a 50 basis point increase. I actually don't think it matters in terms of the stock market at this point, because I think the lows in stocks were put in October, and this is just the housekeeping that the Fed needs to do to get inflation down. So people who are focusing on the magnitude of the hike, I think, are missing the point.
Well, I guess they're focusing because, I mean, you know, how difficult is it to be in Powell's shoes, right? Because he's basically threading a needle, you know, wanting to fight inflation, but how do you do that without tanking the economy? Is it possible?
Again, soft landing is something that people would love to see. I'm not sure that it's a given based on the strength in the employment numbers that the economy is going to tank. I think that the key here is that pretty soon rates are going to be at a point where the underlying trends of inflation, housing costs, cost to rent an apartment, are going to work in the Fed's favor. So I think market influences, the supply chain sort of easing up, and the issues on that regard. I think the Fed's job is going to be easier going forward from this meeting.
It's interesting you say, you know, we get hung up on these hikes. If you're not getting hung up on that, are there any data points that you're closely watching that are concerning you?
Well, here's the point. My old friend Marty Zweig had a two-sentence way to beat the market, which was watch the Fed and listen to the market. And in the last 6 months, the market has been telling us that the worst is over in terms of stocks. And if you look back, we've had a rolling bear market that started in February of 2021 when the hyper tech stocks, as embodied by Cathie Wood and the ARK funds, peaked. And so arguably the bear market's been going on for 2 years. And there was a rolling wave of corrections. More recently, we had a 20% correction in the energy sector. So when you say, is the worst over, or there are things that trouble me, what troubles me is people getting hung up on the headlines and not looking for opportunities in the market. Just to give you an example, there's a whole group of stocks in the industrial sector, construction and engineering stocks, that have made new all-time highs in the last 3 months. If you are hung up on these data points, you miss that. You're sitting on the sidelines with cash, expecting that Mike Wilson at Morgan Stanley is going to be right, and we're going to see the market at 3,000, and you missed an opportunity in some mid and large cap construction and engineering stocks to double your money. And that's where I think people are making a mistake. They're letting the headlines get in front of good, solid investment decisions.
Blinding them, in a sense.
Exactly. There's a great quote from Thomas Jefferson. It says, someone who reads the newspaper is less educated than someone who ignores the press. And he knew that 200 years ago. It's just, I mean, it's almost hypnotic. And of course, they'll trot out the most bearish people on CNBC and on Fox Business because that's what attracts viewers. That's what gets the clicks. You'd be hard pressed to find, a roaring bull on CNBC these days. And I think that's a disservice, but that's what broadcasting's all about.
Mark, let me ask you, when you say you feel the market bottomed in October, I know the folks at home are going to say, what makes you so sure of that? What are you looking at that's telling you that?
Well, we have a pattern that triggered for the 18th time since 1950. It's called a breakaway momentum signal. It was first developed by a guy named Walter Deemer, who was the chief technical analysis guru at Putnam Funds, worked at Merrill Lynch with Bob Farrell, and still going strong into his 80s, blogging on the stock market. Basically, the 10-day ratio of advancing stocks versus declining stocks skyrocketed in January 13th to be exact. That signal has triggered 17 previous times since 1950, and every single one of them, the market was higher 6 and 12 months later, and higher in a big way. And since that signal has triggered, a number of other technical signals have kicked in to confirm that. So this is sort of, and Marty Zweig also came up with a breadth thrust type approach to determining when bear markets were over. So even though Marty Zweig said, watch the Fed, the key from his point of view was listen to the market. And the market has been telling us it wants to go higher.
So that's your response when you see the headline, going back to headlines. I know how much you dislike these headlines, but when you see, folks coming out with saying, the market's going to correct, crash 30, 40, 50% from here.
Well, I was in that camp as recently as January 5th, looking for some capitulation move, looking for price earnings ratios to shrink based on earnings estimates coming down. But then when we got this breakaway momentum move and the market subsequently moved above its 200-day average, and the 200-day average turned up, I changed my view. And that change happened on January 17th. So I'm not really late to the party. Now, we haven't made a lot of upside progress since then, except in those groups that I talked about in the industrial sector, semiconductors. People are moaning that there aren't enough semiconductors. Look at stocks like NVIDIA, Advanced Micro, some of the smaller semiconductor stocks, big moves. So you can call that a bear market rally, or you can participate in a meaningful way based on what's happened with market breadth. And so that's where I've positioned our newsletters. That's where I've reflected to clients that this is the time to be looking for buying opportunities, not time to be scared by the headlines.
What do you do with tech stocks here? Are those a buy, or do you expect them to go more pain for tech?
I think tech is such a homogeneous group that you have to break it down. So you've got software, you've got hardware, you have stocks like Google and Amazon viewed as tech stocks. I think semiconductors are clearly a place I want to be. Some selective software stocks like Adobe, I think are very interesting. Megatech, no. I think the megatech stocks are in for a sobering sort of period. And by megatech, I mean Microsoft,
Right.
Amazon, Alphabet, and so forth.
You know, one of the biggest calls of your career was Riot blockchain. I mean, what about in the blockchain space? Anything that you're looking at now?
No, I'm hands off when it comes to crypto. I just think there's too much uncertainty, too many other shoes that are going to drop, maybe not of the magnitude of the FBX fiasco, but I think there are less volatile ways to make money in the market.
Speaking of which, people who were bearish before on precious metals turning bullish. What are your thoughts on owning some gold in your portfolio right now?
Well, I'm a big believer in mining stocks. Gold is something I've never really had a strong handle on, but I can tell you that copper, zinc, the core metals that get in demand when industrial economies like China are ramping back up are places I want to be. So we found some mining stocks that are diversified, a little bit of gold and silver, but copper and zinc particularly very attractive in here.
Interesting. What about, I just came back from 2 back-to-back mining conferences. Huge focus this year compared to other years on the critical metals. So, lithium, cobalt, et cetera. Are you interested in that sector?
Very much so. Obviously, lithium is key to electronic vehicle market. We've got an awful lot of lithium in this country. There's a controversial mine, as you know, out west that's on Indian land, and they've just started the factory up. And I think that these are critical metals are well tagged. These are critical to the growth of so many industries like EV and semiconductors and batteries in general. So yeah, I'm very strong on the solid companies in that space.
Yeah, just fascinating to get. Just going back to gold a second, you prefer the miner play over owning physical, even though, as we know, it's way more volatile. But you're embracing that volatility just because you think.
I just don't think gold is going to play the same role that it played in the past. For instance, gold was considered a safe haven in inflationary times. It hasn't worked that way. Bitcoin for a bit took over that role, especially with the millennials and the younger generation of investors, who don't know the difference between gold and goldenrod. So I don't think gold, from my point of view, has the same appeal that it did for investors looking to diversify and protect assets in inflationary times, which was a key role for gold historically.
But Mark, if you look at last year, yes, gold ended the year flat, but vis-a-vis other assets, it outperformed basically everything else. So could you not make the argument that actually, in the face of inflation, you were better off being in gold?
Well, you're also better off being in cash that was yielding 5%. So I've never been a big fan of gold, or had a good handle on why to own it and where it was going. But I can tell you that you can find stocks yielding, for instance, in the pipeline area, yielding a safe 9%, which I think is a better play against a bear market than gold.
So you like the majors if you were in the gold space, like the Barricks, the Newmonts?
No, I'm looking at things like FCX, TECK, the more diversified mining companies, where you will get the benefit of the industrial demand. Okay,
want to talk your big event coming up on Stansberry on March 28th. What can we expect to hear? Because I heard through the pipeline you have a big reveal.
We do. Well, you and I have talked about the power gauge. It's our 20-factor quantitative model, primarily fundamentally driven, and then we overlay 2 technical indicators on top of that, Chaikin money flow and relative strength, to find the best of the best stocks, particularly in strong industry groups. Well, there's a pattern that I observed and developed over a 30-year period that we're now going to lay out as the basis for a trading strategy. And it's something we've never done before. I don't want to reveal too much, but it's a unique way to use the power gauge and a very specific technical pattern that has proven very reliable to accelerate your profits, particularly in a bull market. And since I think we're in a bull market, this is the ideal strategy for investors in that kind of environment.
But actually, we don't have to wait till March 28th. We can actually get a sneak peek of Marc's big reveal if you go to chaikinevent.com, correct?
Correct.
All right. Well, I look forward to it, Marc. I can't wait to know what it is. So I'll definitely be watching. And thank you so much for joining me today.
Danny, it's always a pleasure. Thanks very much.
Yeah. Again, that's chaikinevent.com if you're interested in Marc's big reveal. And thank you for watching. We'll have more incredible content heading your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com so you can stay on top of all these interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.